Guest of the morning, Adrian Mowat, Managing Director, Chief Asian and Emerging Market Equity Strategist at JPMorgan, joins in. Good morning, Adrian. Thank you very much for joining us. The overnight news that we've got look extremely depressing. Brazil downgraded to junk status. S&P also downgrading GDP forecast for the entire Asia-Pac region. Machinery orders in Japan, the PPI in China. Are we going to see a much more, downgrades to global growth itself?
Look, I think there's maybe some risk to further downgrades to global growth, particularly sort of emerging market growth, although that has been the trend for a period of time, and we've had very weak global trade, with Chinese imports down something like 14% year to date. But it's very important to remember here that we're sort of in equity markets which are forward-looking. We've seen a correction of around 30% in emerging market equities since the April highs. That's a very large correction, even in an asset class that's quite volatile. So we are already pricing in a pretty bearish outlook. And I think what we're going to actually see over the next couple of months is some stabilization in data. We had a very sharp rally in car companies in China yesterday. The auto sales numbers, auto production numbers came in around flat. They were expected to be down. You know, there's a perception out there that the sort of Chinese economy is in recession. You know, year to date, car sales as measured by registration is up about 8%. It doesn't really feel like a recession in the world's biggest auto market. We're seeing home sales in China plus 20% year over year. And that's really a story of better affordability. Mortgage rates have come down, prepayment requirements are down, and house prices have adjusted relative to household income. We've got very good order inflows into the Chinese construction companies at the moment. In the first half of this year, there was quite significant fiscal underspending. And so I think that the tone of markets, which seem to be incredibly bearish on the macroeconomic environment, which you can understand judging by the historical data, looking forward, that probably moves in the right direction. With regards to Brazil's downgrade, this is something that the market's been talking about for a couple of months. It was JPMorgan's official position for the past 2 months that Brazil would lose its investment grade status. This will put some more pressure on EM currencies, particularly the Brazilian real. We have a forecast of 435, which is a meaningful devaluation from current levels. But I think Brazil has unique problems. It is not a broad issue for emerging markets. People think that the EM benchmark is lots of bricks, but it's not really anymore. If you add Brazil and Russia together, it's only 10% of the benchmark. It would help if they weren't going down, but I think we can live without them going up. The other thing we want to highlight is the tech space. Now, the whole Apple story seemed to be totally underwhelming. No one's sort of covering it. But behind the scenes, we're seeing a recovery in the semi-cycle. And in these falling markets, we've been seeing some large tech stocks in Asia and also in developed markets beginning to go counter-trend in terms of their rising against falling markets. We're also seeing that in some of the Korean auto names as well. So I think, you were talking about another strategist recommendation, very similar views on this. Markets are at, near GFC lows. Valuations are very down. The confidence is extremely weak. And that tends to be a good buying opportunity. Remember that the median return post-correction in EM over a 12-month period is around 30%. So in the past, it has paid to go against the trend. I know at these points, your confidence level tends to be at its lowest. But I think the smart money, if they're willing to take a medium to long-term view, are getting a good entry point today.
Okay, that's an interesting point. Adrian, hi, good morning. Good to speak with you as always. You were mentioning that a lot of emerging markets have corrected 30% already. But how does India feature in this basket? Because we haven't yet seen a 30% correction in this big bull run that started last year. Do you fear more downside in the Indian markets?
Look, I could see, a period where perhaps, India in a recovery does not get the same sort of beta because it hasn't fallen as much. And also there's a positioning issue in India that we've talked on many occasions about, which is, clients are relatively more optimistic about the fundamentals in India and are therefore positioned overweight India within an emerging market context. So I think there is an argument that maybe India lags in a recovery trade, and that's more a technical factor rather than necessarily a function of the relative fundamentals.
Okay. Adrian, is there a risk of more debt downgrades, or is Brazil the big one and that's out of the way?
Brazil seems to be the big one. What we've seen in the balance, if you look at the balance of LATAM, the Mexican fiscal management is extremely good. Balance of payments are fine. They've put through a reform program, so people are comfortable with Mexico. In Colombia and Peru, they face some real challenges with declining commodity prices, particularly energy prices. However, macro management has been reasonably prudent. And we would make a sort of similar statement about Chile. So we think that Brazil is a particular case. When we look at if we look at Eastern Europe and Africa, there are some concerns about balance of payments in South Africa, but it's not our view that they're going to lose investment grade rating, and the rand has basically been taking the pressure. In Asia, there were some concerns around Malaysia defending its currency, never in concerns about sort of investment grade rating, but concerns about its currency being defended at 3.8. Very sensibly, the Malaysian government stood away and is allowing the market to set the rate, and you've seen the ringgit weakening very substantially, which looks disturbing, but actually I think it's exactly the right thing to do. We're fielding a load of questions about, is this 98? Is this the Asian financial crisis? Our response to that is no, it is not. Currencies are acting as the shock absorbers. FX reserves are high. Current account positions look pretty good in places like India and Indonesia. There's been a notable narrowing in the current account position. So I think you've got an understandable risk-off event. You've got all the pressure that associates with a strong dollar, weak euro, weak yen, renminbi move, causing a currency move. But I don't think this is an event where you have other Brazils out there.
Okay.
Adrian, good morning. That point is taken, but I was just looking at some data. For India in particular, in dollar terms, we are back to 2009 levels. Do you think long-only funds will lose a bit of patience because they're making money in the mother markets, in other markets, but in India, in dollar terms, you're practically not making any money in 6 years?
Look, EM equities have underperformed developed market equities by 60% in the last 5 years. Trust me, there's very few people out there that have much good to say about emerging market equities. I was in the States and Canada over the last 2 weeks. I'm finding global clients with record low positioning in these markets, and generally a very bearish bias. That said, with those record low positioning, they wanted to know what was going on in emerging markets, and I think their perception is probably much more negative than the reality. So, in a year where we've had nearly 40 billion of outflows from EM equities, and I'm including sort of China in with that statistic, this is almost 2008, which was, the GFC. So I actually think the whole positioning argument is highly bullish rather than bearish.
Okay, and that point is taken. Your views are eerily similar to Jonathan Scheisel of Ashburton, who we spoke to just yesterday afternoon when the markets were closing. And even the kind of stocks that he mentioned, so he did tell us that he's increasing his allocation to some of the private sector banks like ICICI Bank and Axis Bank. And I look at your model portfolio and you have an overweight on these private sector banks as well. Some of these stocks have corrected 15-20% this year already. Is this a good time to be sort of increasing your weightage to some of these quality names?
So, we're out there with a call, which is a counter-consensus call, clearly counter-trend, to add to emerging markets. And, in the case of the private sector banks in India, these are very good long-term investments. And when you get these types of corrections, yes, we think you should be adding to them. But you asked me a question earlier about, what will be the nature of a rebound. A 15% fall is a modest fall relative to what we've seen elsewhere in EM.
Okay. Well, Adrian, yes, I got your call that this is the time to buy the dips. But do you think the market has adequately downgraded Indian stocks as a result of the global downgrades? I mean, we did see some bit of downgrades after the fourth quarter and the first quarter numbers in India. But, the new global arithmetic that we are coming to terms with over the past 12 weeks, has that been factored into Indian numbers? After all, a weakened global economy will also mean chipping away some of the earnings in India, won't it?
So let's just think about the question you just asked me. The US economy is running above potential, as is the European economy. Yes, we did have some downgrades on Japanese GDP. The second quarter print for the US economy was 3.8%. Last night we had job vacancy data. So these are unfilled jobs, which is at the high that we last saw in 2001. In peripheral Europe, I'm seeing economies in the Czech Republic, Hungary, Poland running well above potential. Spain is growing at 3%. I don't understand this story that there's something wrong with the global economy and it's weakened. No, stock prices have gone down. But if people paid attention to the IFO survey in Germany, if they looked at the labor market data in the United States, then they would understand that the global economy is probably looking the best that we've seen since the GFC. Maybe what's happened is the S&P, which had been lovely, rising every year, has lost trend and has corrected. And I think a lot of that probably is to do with two big factors. One is confusion around whether the Fed will move on the 17th of September, and substantial confusion around Chinese policy, particularly the PBOC's actions in moving the renminbi from a fixing to a more market price and then proceeding to do a lot of intervention.
Okay. So are you increasing your allocation to India, or have you increased your allocation to India in the recent fall? And if yes, to what pockets?
Well, I make recommendations, so I don't change my allocation. But if you look at the sort of model portfolio we've been running, we upgraded Korea and Taiwan last week, and we think the case for those is very strong. So at the margin, we've been funding by reducing our overweights in countries like India. So I think, Korea and Taiwan are probably the key stories here.
Well, Adrian, Sonia referred to your overweight position in some of the private sector financials. How else would you play the India story? Are you confident of fiscal spending on investment-related stories, roads and railways? Is there any way you will play that? Any other themes you're playing in India?
Look, I think we should probably talk about here in terms of delta in India, and I think there has been two negative delta points. We come to the end of the monsoon. It's clearly a deficit now, rather than, we've tended to go backwards and forwards about worrying about whether it was deficit or above average. And so, the trade that maybe the adverse rural consumption might begin to turn around, I think that looks less likely. And then there's some debate about the interaction in terms of RBI policy. We also had the hope that India would move to a common market through GST. That looks less likely as well. And so the other dynamic is that the rupee has followed other EM currencies weaker. So I think you're probably thinking about a slightly more defensive quality strategy in this environment. So the Indian IT names are still looking attractive within the story. The right high-quality private sector banks, because maybe the SOE banks or PSU banks, I beg your pardon, are more exposed to bad debts in rural India. And I think in terms of playing fiscal spending, our preferred way is to do that through building materials, through the cement names, where it's an easier story to execute on than maybe large construction projects.
All right, Adrian Mowat, pleasure speaking with you. Thank you very much. We have three willing listeners here to be convinced about the fact that the emerging market story has been beaten down and perhaps oversold into. Thank you very much for joining us with your thoughts.
Thank you.
All right, so that's actually the global growth story, not at all looking all that bad the way Adrian has pitched it. Yes, some downgrades in the Asia-Pac region in some emerging markets, but the global economy still, if you looked at the US, if you looked at some European countries, East Europe, still looking, fairly intact, and so we shouldn't worry so much about India's export earnings. We'll slip into a break on that note, and then